Hold on. So let me get this straight. Now, the chairman of the Federal Reserve, Jay Powell, is saying that this bank bought too many treasuries after the trillions, 4 or 5 trillion, I don't even remember how much it was, of buying treasuries by the Federal Reserve during the COVID lockdowns. Now, Silicon Valley Bank bought too many treasuries, and that's why it's a rogue bank that's an outlier that has gone bankrupt? Are you kidding me? Well, hello there, my friends. Rafi here from the Endgame Investor, and it looks like Jay Powell has finished his job of hiking rates with a 25 basis point hike yesterday or 2 days ago if you're watching this on Friday. And in my humble opinion, and I could be wrong as always, but I believe that this is the last rate hike of the Federal Reserve System ever. I'm not saying the last rate hike in this cycle. I'm saying the last rate hike in this monetary system ever.
Best death ever.
And why do I say that? Because they have stopped hiking rates, because the banking crisis that started with Silicon Valley Bank and went to Signature Bank and now is in First Republic Bank and other banks and Credit Suisse, that is freaking them out. They are not hiking anymore, and they are going to cut from here with price inflation CPI levels at 6, 7, 8%, which means they're going to go up to 15, 20, 25, 30 with banks getting sick, and they will understand from here that another 50, 75, even 100 basis point hike is not going to put a dent in consumer prices, as it barely has at this point, going from 0 to 5.75%. Is that where it is now? Barely touched consumer price inflation, and they are going to understand that any tiny little hike from here is going to destroy the entire banking system, just like it did in 2008 from the hikes that they embarked on until 2006. And now, last week, Credit Suisse blew up and was sold to UBS in a shotgun wedding. And one of the conditions of that wedding was something called AT1 bonds, additional tier 1 capital bonds, were wiped out, about $17 billion of them. And there's about $270 billion of this stuff floating around the financial system, owned by a bunch of rich people who bought that instead of buying gold and silver. So what do you think they're going to buy now that their high yield little instruments have been wiped out? Are they going to buy them again? The answer is no. And banks are not going to be able to raise a lot of money selling this garbage paper either. But anyway, folks, before we start the slides, I wanted to talk about why Credit Suisse was saved, why its equity was saved before the AT1 bonds, and what a systemically important bank does that is so important to the inflated financial system. Well, Credit Suisse is a market-making bank in derivatives. That means they buy derivatives from shorts on one side and they sell derivatives to long on the other side. So they buy and they sell. They balance their balance sheet, their books, by doing so, and they profit off the spread of buy and sell in derivatives. Derivatives meaning, let's say it's an oil contract or a wheat contract or any commodities contract, gold contract, silver contract. They are even on both sides and they profit on the spread. Now, if their equity structure collapses and debt holders get liquidation rights and all those positions are liquidated, then you have a market-making bank in derivatives closing both sides of its positions at the same time. Then you have open interest in the futures markets and all kinds of commodities collapsing as contracts are closed. And what happens to the price of commodities when open interest collapses like that? That means the artificial supply of commodities in paper terms falls, and the market starts to understand that the actual supply of commodities is much lower than the derivatives market reveals it to be. Then you have a chain reaction where commodities prices go up and up and up and up. It's not just gold and silver markets that are manipulated through commodities, and I'm not talking about spoofing and those other small things, and that does happen. I'm talking about the existence of fractional reserve commodities derivatives itself. That is what suppresses prices in the commodity complex across the entire spectrum. And if a systemically important bank like Credit Suisse falls, then that fractional reserve commodity trading ends because it starts a domino effect where other systemically important banks have to close their positions as well. Anyway, let's start with a few articles and then we'll get to the slides. This week's Silver Report is brought to you by Fortuna Silver Mines, symbol FSM, and the news out this week is that they have reported updated mineral reserve and mineral resource estimates as of December 31st, 2022. And the highlights, the big changes are in its Seguela mine project in West Africa that has added to measured and indicated resources exclusive of mineral resources, reporting 1.1 million ounces of gold and 10.5 million ounces of silver, representing a year-over-year increase of 32% in gold and no change in silver. Well, considering they acquired a bunch of gold mines, that makes sense. It looks like Fortuna is bouncing off the 50-week moving average and should be heading higher from here, as gold and silver have a possibility of spinning out of control higher if this banking crisis continues, which it seems very likely. Let's start with this ridiculous article, ridiculous title, with Powell talking in that little video underneath. It says, Powell, Silicon Valley Bank was an outlier.
Yes, we had to take some losses in our subprime department last year, but those losses will be contained at only 5%.
Well, should we even go into the first paragraph of this nonsense? How about the subtitle? The Fed chair offers his first comments on the current banking crisis, saying the system is sound and resilient. So let's go into the second paragraph where that quote is. This was a bank that was an outlier, he said in a press conference following a Fed decision to hike interest rates a quarter point, citing the institution's high percentage of uninsured deposits and its large investment in bonds with longer durations. These are not weaknesses that are there all broadly through the banking system. What the hell is he talking about?
There is a 0% chance that your subprime losses will stop at 5%. Zero.
Oh, the banking system's losses will be contained at 5%. Hold on, so let me get this straight. Now, the chairman of the Federal Reserve, Jay Powell, is saying that this bank bought too many treasuries after the trillions, 4 or 5 trillion, I don't even remember how much it was, of buying treasuries by the Federal Reserve during the COVID lockdowns. Now, Silicon Valley Bank bought too many treasuries, and that's why it's a rogue bank that's an outlier that has gone bankrupt? Are you kidding me? He's saying that treasury bonds are not systemically infecting the banking system? How could that possibly be when you rate treasury bonds as AAA and you encourage banks to buy them so that the federal government can finance its deficits? This is a systemic issue. Yes, you could have an outlier bank where some rogue trader does something crazy and bankrupts it within days. But this is not that. This is bond prices falling because the Fed is raising interest rates and then banks loaded with treasuries losing their money. Of course, this is a systemic issue because it's the treasury market. Let's go to Daniel Oliver, my favorite gold and silver analyst. In this research paper published on March 15th, Daniel Oliver states in the first paragraph, he makes it clear what the difference is between 2008 and now. This is a financial crisis. We're at the beginnings of it. We're going to go through the timeline in a second, but it is very different from 2008. How? Very simply. First paragraph here, boom. From July through December 2021, he says, the average fixed rate for a 30-year mortgage hovered around 3%. Most homeowners locked in this gift from the Federal Reserve. The low rates triggered manic building and bubble pricing as they always do, but unlike the bubble of the 2000s, 92% of mortgages were fixed rate. Rising interest rates became more threatening to lenders than to borrowers. So in 2008, the problem was with insolvent borrowers. They weren't paying their mortgages because it was variable rate and they couldn't afford it. And then you had a housing collapse. This time, 92% of mortgages are fixed rate. People figured out that you don't get variable rate mortgages when interest rates are low. You lock in the damn rate and you put the bank on the hook for it. So yes, now the banks are on the hook for mortgages and all other kinds of debt, which are rising in interest rates, meaning falling in value. Any kind of debt they own is falling in value and their balance sheets are getting destroyed. And so after Silicon Valley Bank failed, after Signature Bank failed, Credit Suisse was next. And now, who owns these AT1 bonds that were wiped out in the deal with UBS. Remember, there are 270 billion of this paper. Now, Bloomberg asks that exact question. Opinion by Shuli Ren, who is stuck with Credit Suisse's worthless AT1 bonds. Now, she discounts a whole bunch of possibilities, and finally, she concludes this leads us to the ultra-rich, wealthy individuals as well as small to mid-sized family offices in Hong Kong and Singapore have gobbled them up, and a lot of them are in shock, according to the Financial Times. JP Morgan Chase and Company concurs, commenting in a recent report that we do not have data on who holds AT1, but we expect it to be held by institutional investors as well as private bank clients, meaning ultra-rich people. And when ultra-rich people get wiped out, they get pissed and they stop trusting paper and they move to gold. They don't move to silver. Ultra-rich people move to gold. And now as gold moves higher and higher, eventually the middle class and the average guy in the street is going to understand what is going on, what the rich people are doing, and they're going to go after silver. Now, let's go to my slides. Now, I want to go into the history of 2008. We just saw the beginnings of a banking crisis that began with Silicon Valley Bank, moved to Signature Bank, and to Credit Suisse, but that doesn't mean that every single day there's going to be something. Remember in 2008, March 16th, 2008, is when Bear Stearns collapsed to $2 a share. This is the Bear Stearns chart from 1992 to March 16th, 2008. Mid-March, it seems to be like an important month these days, or these years, but let's continue. What does Silicon Valley Bank look like? Very similar. Silicon Valley Bank, March 9th, 2023. Very similar chart. Goes parabolic, crashes. This ends here at 106.04, but we know it went a lot lower than that. And it was basically, I think the UK branch was sold for $1 or something, or £1. This bank is pretty much worthless now. But recall again, Bear Stearns was March 2008. And now I've superimposed these big bank events of 2007, 2008 over the NASDAQ here, because the NASDAQ is what we all remember most clearly, or at least what I remember most clearly, is when the main stock market indices started to really crash. That was what I remember most. So here you have in July, August 2007, that is the Fed's first rate cut. Then in November 2007, you had Fannie Mae starting to collapse. In March 2008, you have the first major bank failure, Bear Stearns. That's March. And then if you go all the way to September, so that's about 6 months, 6 months later was Lehman. And that is the full-blown financial crisis when everything starts to deflate. And so we're going to be watching this like a hawk because we know what happened in 2008 and we are a different generation now. But last time it took 6 months for everything to really gather steam and for everything to start crashing. It didn't happen all in one day. It didn't happen all in 1 week. It took about 9 months from the beginning of the rate cutting cycle. I don't think it's going to take that long this time, but we might have a few months until things start really getting out of control. And when they do, it's going to mean Fed rate cutting, intense rate cutting, probably right back to zero in some kind of crisis. And then we're going to start seeing consumer price inflation really start to move in scary ways. And that is when the public is probably going to wake up and get some real money. And they're not going to have a lot of time, and they're not going to be able to acquire a lot of it because the dollar is going to lose value so quickly that gold and silver companies are not going to be able to sell it for dollars. And so we're waiting for the next crack to reveal itself. It could take days, it could take weeks, but once it happens, the likelihood of emergency rate cuts increases, and consumer price inflation from there is going to climb very fast. And then you're going to get your panic into gold and silver, gold for the rich and silver for the masses.
And as fun as it is to watch pompous, dumb Wall Streeters be wildly wrong, I just know that at the end of the day, average people are going to be the ones that are going to have to pay for all of this.
And yes, while most people, average Joes, average guys, are going to have to pay for these mistakes, you don't have to be one of them, because you can protect yourself with real money right now. And I have a feeling that time is running out. But again, anything could happen here. This is a very dangerous time, It is important not to be emotional about this and to approach everything rationally. Keep liquidity that you need in cash and make sure you have the positions that you need in order to not be tempted to chase if things get out of control. Because in the end, the emotionally balanced people are going to be the ones who come out of this intact, whole, and sane. So while last week was Silicon Valley Bank, this week was Credit Suisse. What is going to be next week? We don't know, but we will find out in a week. But in my opinion, the financial singularity is forming, and we are running out of time to make our final preparations. This is Rafi of the Endgame Investor. If you enjoyed this video, consider signing up for a 2-week free trial of the Endgame Investor and lock in an annual rate. Or consider signing up to be my patron on Patreon, where you will get a weekly biblical commentary of monetary and economic policy topics for as long as the financial system remains intact enough for everyone to have an internet connection. Last week, we had a look at democracy and whether that system is a legitimate form of government at all. See you guys next week.